Okay, now we're on to the mini lecture for Learning Outcome 8-3, Computing and Reporting Interest on Notes Receivable. Now you might recall the term note payable back from Chapter 2. In Chapter 2, we used a note to purchase a long-lived tangible asset. For example, we might have bought equipment or land and paid part of the purchase price in cash, and the rest of it we owed, and we used a note to represent that promise to pay. A note is, when we say note, we refer to a promissory note, a written promise to pay a specified sum in the future. Usually the sum would be the principal and interest. Now there's two sides to every note, just like there's two sides to every coin. There's the person to whom the money is owed, and to them it would be a note receivable because they'll be receiving the money in the future, and the person that owes the money, and to them it would be a note payable because they have to pay it in the future. Okay, so a note is a formal written contract establishing or outlining the terms by which a company will receive amounts it is owed, and as I mentioned, it's usually principal plus interest. Notes receivable differ from accounts receivable in that notes generally charge interest from the day they're signed until the day they are collected, which is called the maturity date. Another way in which they differ is that notes usually cover time periods greater than just the standard 30 or 60 day accounts receivable period. They can go for any length of time in terms of days, months, or years. Now notes are usually used in one of three situations. The company loans money. It could be to an employee or another business. The company sells expensive items for which customers require an extended payment period. Or the company is converting an existing accounts receivable into a notes receivable to allow an extended payment period. In other words, the customer or client already owes you money on an accounts receivable, and you want a little bit more security if the customer wants an extended time period. So you're going to remove that accounts receivable and in its place establish a notes receivable. Now, it tells us here that interest on notes receivable is earned each day. That's true. Just like with the bank account, we earn interest day by day, but interest payments are received only once or twice a year. And when we're talking about short-term notes, you're going to get paid your interest at the same time as you receive the principal unless it's otherwise specified. And short-term notes mean 1 year or less in length. So if you're dealing with a short-term note, principal and interest is usually paid at the same time. However, if your year-end or period end comes in between the time a note is made and collected, then you have to accrue interest. You have to get that interest on your interest receivable on the balance sheet in the correct period and the interest earned on your income statement in the correct period. In other words, this is Chapter 4, Adjusting Journal Entries. We need to accrue interest revenue and record interest receivable whenever we produce those financial statements, the income statement and the balance sheet. Now, how do we calculate interest? We're just going to be calculating it on the simple interest basis. Principal times rate times time. And here are our definitions. Principal is the amount of the note. The annual interest rate is represented by R, and again we talk about it being an annual rate, and then we multiply by the time period, and that's expressed usually in days or in months. For ease, our text uses just months, but notes can be also expressed in terms of days as well. Now, interest is always stated in an annual rate or annual percentage, even if the note is for less than a year. So it's really important that we multiply by a fraction that represents the portion of the year that the note is covering. So here's some examples. We have a $100,000 note. That's the principal. We're going to multiply by 0.06. And if we calculate the interest for 1 year, the time frame can be expressed as 12/12, which is equal to 1. That would be $6,000 of interest earned over that time period, January 1st to December 31st. If the note matures in 10 months, that's a short-term note. It's 1 year or less in length. We'd multiply the $100,000 times 6% times 10 months divided by 12. And so interest earned would be $5,000. If that same note matures in 2 months, the principal, $100,000 times the interest rate, 6% times 2/12. Notice the denominator is always 12 because it represents a year. If the note were stated in days, we'd use 365 as our denominator or bottom portion of our fraction, unless it's a leap year, and then it would be 366 days. Okay, now let's take a look at the journal entries for notes. Okay, so when recording notes receivable and interest revenue, there are 4 key events. The first one is to establish the notes receivable. That means when the note is first made. Our example is on November 1st, 2015, VFC lent $100,000 to a company by creating a note that required the company to pay VFC 6% interest and the $100,000 principal on October 31st, 2016. So this is a 1-year note. It's considered a short-term note because a short-term note is 1 year or less in length. And what I usually tell my students is, when you receive a note, debit notes receivable. It doesn't matter the purpose. It could be for a loan, it could be for a sale with extended time period, or a reclassification of account receivable. When you receive a note, debit notes receivable. What we're giving is cash, so we reduce the asset cash. What we're receiving is a note, so we debit notes receivable. We're going to be receiving the cash at a later point when the note is paid. Okay, now if on December 31st your year ends, or it comes time to do a set of financial statements, we need to accrue interest earned. And this is your Chapter 4, Adjusting Journal Entry. You actually have learned this entry already. We have to make sure we record the interest revenue in the correct period and show the interest receivable on the balance sheet. Now, most accountants would be preparing their financial statements monthly. If so, then this accountant should have accrued interest on November 30th once the month has passed first, but they did not. So we're going to record interest for the month of November and December. Remember, when someone has use of your money, you are earning interest. So we have to record the revenue that you earned from that interest, from the fact that someone is using your money. So we're going to multiply the principal of $100,000 times the interest rate times the 2 months that they've had use of your money, November and December. Divide by 12, and that gives us the $1,000 that will go on our balance sheet at December 31st. As an asset and a credit to interest revenue. That's how much interest we've earned over those 2 months. Now let's say that accountant's been really lazy and they haven't recorded any interest, even though it's being earned day by day. And the due date comes, October 31st. We call that the maturity date. So on that date, the company will be receiving all the interest in cash that is owed. For the full year, you're receiving the cash payment. So $100,000 times 6% times 12/12, because it's a 1-year note, you're going to receive in cash $6,000. However, remember you already recorded the interest that you earned for November and December, and you're just getting paid for that. Back here in the second journal entry we recorded the interest earned for 2015. So we're just receiving this now. So we're going to credit this interest receivable account to show that we did receive it, and we'll record as revenue only the interest for January 1st through October 31st, which is 10 months. So we split the interest in two parts. The interest earned last year gets recorded December 31st of 2015, and the interest earned this year gets recorded October 31st of 2016. So this is the other 10 months. Together, they add up to the full year's worth of interest that we've earned. The next part is receiving the principal, and this is basically reversing the entry that we used to create the note. You're going to be receiving the principal in cash, and you're going to be crediting that note receivable. Now you might be wondering, why would someone write you two separate checks, one for interest and one for principal? And in truth, they don't. In reality, they're going to give you one big check for both of the interest and principal. They would give you a check for $106,000. So this entry can be really combined into one. One big debit to cash for $106,000 and three separate credits. A credit to interest receivable, a credit to interest revenue, and a credit to notes receivable. And we're done with this mini lecture. You could go on to the demonstration problem for notes receivable.